Right now, at this very moment, warehouses across 3 continents are reporting the same anomaly. Delivery timelines that once took weeks now stretch into months. Orders placed, but never filled. In 1980, the world faced a crisis of demand. Prices spiked, then supply caught up. But what's happening now is fundamentally different. This time, it's not about demand, it's about physics. The ground beneath our feet is running out of what we need most, and the collision point is closer than anyone in boardrooms wants to admit. Welcome to Currency Analyzer. You know, my friend, if you've lived through a few economic cycles, you understand that some warnings aren't meant to alarm, they're meant to prepare. If you value that kind of clarity, the kind your father or mentor might have given you over coffee, then perhaps you'd consider subscribing, not for entertainment, but for understanding. Before we continue, I'm curious, where are you watching this from today? Drop your city or country in the comments. Let's see how global this conversation really is. Now, let's talk about what they're not telling you. In the spring of 2024, a procurement manager at a German automotive company sent an urgent email to his supply chain team. The message was simple but alarming. Their primary copper supplier could not fulfill the quarterly order, not because of logistics, not because of labor strikes, but because the material simply was not available. This was not an isolated incident. Across the Atlantic, a solar panel manufacturer in California faced the same problem. Their silver paste supplier pushed delivery dates from 6 weeks to 16 weeks. No explanation, no alternative, just delay. In South Korea, a semiconductor fabrication plant received notice that indium shipments would be cut by 30%. The reason given was vague. Supply constraints upstream, nothing more. These are not headlines, these are internal memos, quiet conversations in boardrooms, the kind of problems that do not make the evening news. But they shape the economy that comes next. Something fundamental is breaking in the global supply system, and most people have no idea it is happening. To understand the scale of what is unfolding, one must look back to 1980. That year marked one of the most significant commodity crises in modern history. Oil prices had quadrupled. Copper hit record highs. Inflation ravaged economies. Central banks raised interest rates into double digits to crush demand. But here is what made 1980 different from today. In 1980, the problem was demand. The world wanted more than it could immediately supply. Prices spiked, consumers pulled back, industries slowed down, and within a few years, new mines opened. New oil fields came online. Supply caught up, balance restored. The system worked because the resources were still in the ground. It was just a matter of time and capital to extract them. Today, the equation has flipped. The current crisis is not driven by excessive demand. It is driven by the hard limits of geology. The high-grade deposits that fed industrial growth for a century are depleting. What remains is deeper, lower quality, and exponentially more expensive to extract. Consider copper. In the 1980s, a typical copper mine processed ore with a grade of 2%. That means for every 100 tons of rock, 2 tons were pure copper. Today, the global average is below 0.5%. Miners are moving 4 times the material to extract the same amount of metal. This is not a temporary inconvenience, this is physics. Silver tells an even starker story. 70% of the world's silver is not mined for silver. It comes as a byproduct of lead, zinc, and copper mining. When those base metal mines deplete or close, silver production falls automatically. There is no switch to flip, no price point that suddenly makes new silver mines viable at scale. The world uses silver in every smartphone, every solar panel, every electric vehicle charging system. It is the most conductive metal on Earth. There is no substitute that performs at the same level. And yet, inventories are at multi-decade lows. This is what analysts call a supply cliff. A supply cliff is the point where production cannot increase regardless of price. Demand continues. Supply flatlines. And the gap between the two widens with every passing quarter. It is not a curve, it is a cliff. Economists and policymakers operate under an assumption that has held true for generations. The assumption is simple. If prices rise high enough, supply will respond. Miners will dig deeper, engineers will find alternatives. The market will adjust. But what happens when the market cannot adjust? What happens when the resource is genuinely constrained by geology, not economics? This is the question that separates today's crisis from 1980. In 1980, higher prices unlocked new supply within 5 to 7 years. Today, even if prices double, the timeline to bring a new mine online is 15 years. Permitting alone takes a decade in most developed nations. Exploration, engineering, construction, all of that comes after. The world is running on supply lines built in the 1990s and early 2000s. Those lines are thinning, and nothing is being built fast enough to replace them. The implications are vast. But they begin with a simple truth. The modern world is built on materials that are becoming scarce, not because of speculation, not because of geopolitics, but because of geology. And the industries that depend on those materials, energy, technology, transportation, defense, are about to face a reckoning. Understanding this crisis requires looking at three dimensions. First, the geological reality. What is actually left in the ground, and what does it cost to extract? Second, the demand acceleration. Why consumption is rising faster than at any point in history. And third, the strategic implications. What this means for businesses, investors, and economies over the next decade. The supply cliff is not a theory. It is here, and it is worse than 1980. There is a map that most people will never see. It sits in the offices of mining executives, geologists, and resource strategists. It is not classified, but it is not public either. This map shows every major mineral discovery made in the last 70 years. And when someone looks at it closely, a disturbing pattern emerges. The peaks were in the 1960s and 1970s. Massive copper deposits in Chile, silver veins in Mexico, zinc fields in Canada. These were the discoveries that powered the late 20th century. Then the discoveries slowed. By the 1990s, the peaks flattened. By the 2010s, they nearly disappeared. The last major copper discovery of global significance was made in 2012. That was over a decade ago. And even that discovery will not produce a single ounce of copper until 2030 at the earliest. This is the discovery gap, and it is widening. Exploration companies have not stopped looking. In fact, they have spent more money searching for deposits in the last 10 years than in any previous decade. They use satellite imaging. They drill deeper. They analyze soil samples with precision instruments that did not exist a generation ago. But the results are the same. The easy deposits are gone. What remains is either too deep, too remote, or too low grade to justify development under current economic models. And here's the critical point. A discovery made today will not reach production for 20 to 30 years. Permitting takes 10 years. Engineering and construction take another 10. Environmental reviews add more time. The world is consuming materials today that were discovered in the 1980s and 1990s. The pipeline that fed growth for decades is empty. There is no reserve waiting in the wings. But the discovery gap is only part of the problem. The bigger issue is what geologists call ore grade decline. Ore grade refers to the concentration of valuable metal in the rock. A high-grade copper deposit might contain 2% copper. A low-grade deposit might contain 0.3%. That difference sounds small, but in practice, it changes everything. When a mining company extracts ore, it must move the entire rock mass, crush it, grind it, separate the metal from the waste. The lower the grade, the more rock must be processed. More rock means more energy, more water, more chemicals, more time. In 1900, the average copper mine processed ore with a grade above 3%. By 1980, it had fallen to 1.5%. Today, the global average is 0.4%. That is a seven-fold decline in concentration. Extracting the same amount of copper now requires moving 7 times the material. The energy cost alone has tripled in real terms, and energy is not getting cheaper. Silver faces an even sharper constraint. Most people assume silver is mined like gold. A company finds a silver vein and extracts it. But that is not how the industry works anymore. 70% of the world's silver comes as a byproduct. When a company mines lead, zinc, or copper, silver comes along with it. It is separated during the refining process. This creates a structural problem. Silver production is tied to base metal production. If base metal mines close or deplete, silver supply falls automatically. And right now, base metal mines are closing faster than new ones are opening. Why? Because the remaining deposits are low grade, because permitting is slow, because capital is expensive, because margins are thin. A silver mining company cannot simply decide to produce more silver. It depends on someone else mining copper or zinc first, and those operations are slowing down. This is not a market imbalance. This is a system-level constraint. Then there is the physics of extraction itself. Mining is governed by the laws of thermodynamics. It takes energy to move rock. It takes energy to crush rock. It takes energy to separate metal from waste. And the lower the ore grade, the more energy is required per unit of output. This is not negotiable. A mining company cannot innovate its way past thermodynamics. It cannot print energy. It cannot wish away the physics of material processing. If the ore grade is 0.3% copper, then the company must process over 300 tons of rock to extract 1 ton of copper. That is the reality. No amount of financial engineering changes it. And as grades continue to fall, energy costs continue to rise. The cost floor is rising, not because of inflation, but because of geology. There is another layer to this crisis that few people discuss. The remaining high-grade deposits are not evenly distributed. They're concentrated in a handful of regions. The Democratic Republic of Congo holds over 70% of the world's cobalt. Chile controls nearly 30% of lithium reserves. China refines over 60% of rare earth elements. This creates a geographic bottleneck, but it also creates a political one. Many of these regions are unstable. Governments change, policies shift, contracts get renegotiated, and even in stable regions, environmental regulations have tightened. Permitting a new mine in the United States or Europe now takes 15 years. In some cases, it does not happen at all. The world needs more supply, but the world is also making it harder to develop that supply. This is the paradox of modern resource policy. Some analysts argue that higher prices will solve the problem. They say that if copper hits $15 per pound or silver hits $50 per ounce, new projects will become viable. Supply will respond. But this logic assumes that price is the only variable. It is not. Price cannot overcome geology. It cannot fast-track permitting. It cannot create high-grade deposits where none exist. It cannot reverse the decades-long decline in ore quality. Higher prices might slow demand. They might encourage recycling. But they cannot create new primary supply at the scale required. Not in 5 years. Not in 10. The supply cliff is real, and it is built into the ground itself. In a conference room in Brussels, a policy document was signed in 2021 that most people never read. It was called the European Green Deal. Buried in its pages was a commitment. By 2050, the European Union would reach net zero carbon emissions. Every car would be electric. Every building would run on renewable energy. Every power grid would be transformed. It sounded ambitious. It sounded noble. But what the document did not include was a materials inventory. No one calculated how much copper would be needed to rewire the entire continent. No one asked where the silver for solar panels would come from. No one modeled the lithium demand for 50 million electric vehicles. The policy assumed that materials would simply appear. They will not. This is not unique to Europe. The United States passed the Inflation Reduction Act. China announced its carbon neutrality target for 2060. India launched a massive renewable energy build-out. Over 100 nations committed to some form of decarbonization by mid-century. These are not market-driven decisions. These are policy mandates. Governments are legislating demand into existence. And the scale of that demand is unprecedented. Consider this. A conventional gasoline-powered car contains roughly 20 kilograms of copper. Wiring, circuits, motors, that is the baseline. An electric vehicle contains over 80 kilograms, 4 times as much. The electric motor alone requires 25 kilograms. The battery system requires another 30. The charging infrastructure requires even more. Now multiply that by the number of vehicles being mandated. The European Union wants 30 million electric vehicles on the road by 2030. The United States wants 50% of all new car sales to be electric by the same year. China is already the largest EV market in the world and still growing. This is not a gradual transition. This is a structural overhaul of the global transportation system. And it is happening in 1 decade. But transportation is only one part of the equation. Solar energy is the fastest growing power source on Earth. Installations are doubling every few years. Governments are subsidizing it. Corporations are mandating it. Homeowners are adopting it. Every solar panel requires silver. Not a little. A lot. The average solar panel contains about 20 grams of silver. That might not sound like much, but scale it up. A single 1 megawatt solar farm requires over 60 kilograms of silver. A utility scale installation requires tons. And the world is installing record amounts of solar capacity every single year. In 2010, global solar capacity was 40 gigawatts. By 2020, it had grown to 700 gigawatts. By 2030, projections put it at over 3,000 gigawatts. That is a 40-fold increase in 20 years. Silver demand is not rising linearly, it is compounding. Then there's the digital infrastructure, data centers, 5G networks, cloud computing, artificial intelligence. These are not abstract concepts. They are physical systems that require physical materials. A single data center can consume as much copper as a small city. The wiring, the cooling systems, the backup power infrastructure, all of it requires conductive metals, and the world is building data centers faster than ever before. AI alone is driving demand that did not exist 5 years ago. Every new language model, every new training cluster, every new deployment requires hardware. That hardware requires materials, copper, silver, rare earths, semiconductors that depend on indium and gallium. None of this is virtual. It is all material intensive. And the expansion is accelerating. Tech companies are not slowing down. They are racing to build more capacity, more servers, more processing power, more bandwidth. Each layer of this digital economy pulls harder on the same constrained supply chains. But perhaps the most underestimated factor is this. 3 billion people are entering the global middle class. They live in India, Indonesia, Vietnam, Sub-Saharan Africa, Latin America. These are regions that historically consumed very little in terms of industrial materials. That is changing. As incomes rise, consumption rises. People buy cars, they buy appliances, they upgrade their homes, they demand electricity, they use smartphones. This is not speculation. This is observable economic reality. China used more cement between 2011 and 2013 than the United States used in the entire 20th century. That is not a misprint. 3 years versus 100 years. India is now following the same trajectory. So is Southeast Asia. When a country industrializes, its material consumption does not grow steadily. It explodes. Infrastructure must be built. Power grids must be expanded. Transportation networks must be constructed. And all of that requires copper, steel, aluminum, rare earths. The developed world built its infrastructure over a century. The developing world is trying to build it in 2 decades. The demand surge is not hypothetical. It is already happening. What makes this crisis different from any previous period is the multiplication effect. In the past, demand came from one sector at a time. The 1950s needed steel for cars and buildings. The 1990s needed copper for telecom infrastructure. But today, demand is coming from everywhere at once. Electric vehicles, solar farms, wind turbines, data centers, 5G networks, battery storage, defense systems, medical equipment. Every sector is electrifying. Every sector is digitizing. Every sector is demanding the same materials. And those materials are not interchangeable. You cannot substitute copper with aluminum in high-performance electronics. You cannot replace silver in solar panels without losing efficiency. You cannot build an EV battery without lithium and cobalt. The supply chain is rigid. The demand is flexible only in one direction, up. This creates a collision point. The timeline is the final piece of the puzzle. Peak demand acceleration is happening right now. Between 2025 and 2035, more infrastructure will be built than in the previous 50 years combined. But as established in the previous section, supply cannot scale. New mines take decades to develop. Ore grades are falling. Discovery pipelines are dry. Demand is policy-driven and therefore inelastic. Governments have committed. Corporations have committed. The transition is not optional. But supply is geology-driven. And geology does not care about policy timelines. This is not a temporary mismatch. This is a structural collision between human ambition and planetary limits. In 1980, the world could afford to wait for supply to catch up. Today, there is no time, and there's no supply waiting to catch up. The demand acceleration is real, the supply cliff is real, and the gap between them is widening. There's a principle in economics that most business leaders take for granted. Price is information. When the price of something rises, it signals scarcity. When it falls, it signals abundance. The market adjusts. Buyers reduce consumption. Sellers increase production. Balance is restored. This principle has held true for centuries. It is the invisible hand that guides resource allocation across the global economy. But there is a condition under which this principle breaks down. When supply cannot respond to price, when demand is inelastic, when the gap between the two becomes structural rather than cyclical, that is when price stops being information and becomes a warning. In 2021, lumber prices spiked to record highs. Within 6 months, they collapsed. Why? Because supply responded. Mills ramped up production. Demand cooled. The system corrected itself. In 2022, natural gas prices in Europe surged. Within a year, they stabilized. Countries found alternative suppliers. Consumers reduced usage. The market adjusted. But the supply cliff is different. When copper prices double, mines cannot instantly produce more copper. When silver prices spike, refineries cannot conjure more silver. The material is either in the ground and accessible, or it is not. And right now, it is not. This creates a new kind of price behavior. Not cyclical, not temporary, but structural and sustained. Prices will not rise gradually. They will spike vertically. And they will stay elevated because the underlying constraint is geological, not economic. This is not speculation. This is the mathematics of scarcity meeting inelastic demand. The business implications ripple outward in waves. The first wave hits manufacturing. A car company that cannot secure copper for wiring will delay production. A solar company that cannot source silver will miss installation deadlines. A tech firm that cannot obtain rare earths will postpone product launches. These are not hypothetical scenarios. They are already happening quietly across industries. But delays are just the beginning. The second wave is margin compression. When input costs rise faster than a company can pass them to customers, margins shrink. Profitability declines. Investment slows. In competitive markets, some companies cannot survive this pressure. The firms that do survive will be those with secured supply chains, long-term contracts, vertical integration, strategic stockpiles. Those without will be squeezed out. This is not a level playing field anymore. This is a game of resource access. And access is becoming the ultimate competitive advantage. Governments are beginning to understand this reality. In 2022, the United States passed the CHIPS Act. Billions of dollars allocated to secure domestic semiconductor production, not because of market forces, but because supply chains had become a national security issue. In 2023, the European Union launched the Critical Raw Materials Act. The goal was to reduce dependence on external suppliers for lithium, cobalt, and rare earths. China has been ahead of this curve for 2 decades. It controls refining. It controls processing. It has locked in supply agreements across Africa and South America. These are not trade policies. These are resource strategies. Nations are realizing that economic power in the 21st century will not come from financial capital alone. It will come from material access. The countries that secure copper, lithium, silver, and rare earths will lead. The countries that do not will depend. There is also a monetary dimension to this crisis that central banks are not prepared for. Inflation is typically understood as too much money chasing too few goods. The solution is to raise interest rates, cool demand, bring prices down. But what happens when inflation is driven by supply constraints that cannot be solved with monetary policy? A central bank can raise rates to 20%. It will not create more copper. It will not grow more lithium deposits. It will not reverse ore grade decline. This is a form of inflation that is immune to traditional policy tools. Economists call it supply-side inflation. And it is the most dangerous kind because it persists regardless of demand destruction. In the 1970s, central banks fought inflation by crushing demand. It worked because supply could eventually catch up. Today, crushing demand will not solve the problem. Governments have mandated the demand through climate policy. Corporations have committed capital. Infrastructure projects are locked in. The demand is structural. The supply is constrained. This creates a version of stagflation that no central bank has a playbook for. Economic growth slows, but material prices stay elevated. Productivity suffers, living standards decline, and monetary policy becomes irrelevant. Sophisticated capital has already begun repositioning. Institutional investors are moving into hard assets, physical commodities, upstream mining equities, offtake agreements that guarantee supply years in advance. Private equity is funding resource projects that were once considered too risky or too slow. Sovereign wealth funds are acquiring stakes in mining operations. This is not speculation. This is strategic hedging. These investors understand that the next decade will not reward financial engineering. It will reward resource access. Companies that own or control supply will have pricing power. Companies that depend on spot markets will face volatility and shortages. The gap between the two will widen. There is a parallel to history that is worth noting. In the early 20th century, oil was a niche commodity. It powered lamps, it lubricated machinery, but it was not essential. Then the internal combustion engine arrived, then aviation, then petrochemicals. Suddenly, oil was not optional. It was the foundation of modern civilization. Nations that controlled oil controlled geopolitics. The same transition is happening now with materials like copper, lithium, and silver. They are no longer optional. They are the foundation of the electrified, digitized world. And the nations, corporations, and investors that control them will shape the next century. So where does this leave the business community? The answer is uncomfortable but clear. This is not a problem that can be solved by waiting. It is not a cycle that will self-correct. It is not a temporary disruption that will fade with time. The supply cliff is structural. It is geological. And it is here. Businesses that depend on these materials must secure supply now, not next quarter, not next year, now. Those that do not will face delays, cost overruns, and in some cases, project cancellations. Investors must recognize that resource scarcity is not a theme. It is the reality of the next decade. Policymakers must understand that mandating electrification without securing materials is not a strategy. It is a recipe for failure. In 1980, the world faced a commodity crisis driven by demand. It was painful, but it was solvable. Today, the world faces a commodity crisis driven by geology. It is not solvable with higher prices. It is not solvable with monetary policy. It is not solvable with optimism. The supply cliff is real, and it is worse than 1980, because this time, supply cannot catch up. The warning has been issued. The question now is, who will listen?